Welcome to Investors Guide. You're watching ET Now. This is the show that helps you find the perfect investment products in the market by looking at what suits your needs best. You can write to us. There's an email ID at the bottom of your screen where you can send in any question you have about your money. All right, let me bring in Dhirendra Kumar, the CEO of Value Research and our Railhouse Mutual Fund expert who joins us every week. Dhirendra, thank you so much for joining us on Investors Guide. Let's get straight to our portfolio versus portfolio question. Well, 37-year-old Satish Kumar writes in from Bangalore, Dhirendra. He has been investing 15,000 rupees every month in mutual funds with the aim of generating about 1 or 2 crore rupees in the next 25 years. He sent us a list of the funds he's investing in. But interestingly enough, if he's been investing since 2007 and he continues investing the same amount for the next 25 years, it's likely he'll have round about 6 crore rupees. So I think he's fairly on track as far as his investment is concerned. But taking a look at his mutual funds, he has the Franklin India Blue Chip, the DSP Black Rock Top 100, L&T Equity, L&T Global Real Assets, Quantum Long-Term Equity, IDFC Premier Equity, and SBI Emerging Business. He's obviously someone who listens very carefully to your advice. Do you want him to make any changes to his portfolio?
Ideally, somebody investing for next 20-25 years, he should try and choose investments which are flexible enough to participate in all segments of the market, which means one should keep away from funds, or one should not invest in, one should not make an investment which is very rigid and has a very narrow focus. And so even though he has chosen good funds, something like Franklin Blue Chip or DSP Black Rock Top 100, which will always be a large cap fund, and they have done very well in recent times. But I think he'll be he'll be better off with something like L&T Equity or funds which have greater flexibility of moving across the market, and that will actually keep him away from monitoring it very closely and remain focused on just savings.
All right. So when you can save more, you should increase your investments. But like Dhirendra said, your portfolio seems fairly on track. You just need to eliminate 2 of those funds from your list. Dhirendra, he also writes in saying he plans to invest an additional 3,000 rupees a month over a 10 to 15-year horizon for his children's education. But he wants to invest in a balanced fund because he doesn't want this money that's meant for his children's education to go to any sort of market volatility at all. We want you to recommend a balanced fund that he can use for this money. What would you recommend he invest in?
No, he can well consider, funds from our stable growth portfolio. It's a nice collection of balanced fund, and he can choose, maybe 2 of the 4 funds which we have there. But that apart, I would, he will not be able to escape market volatility by investing in a balanced fund. Balanced fund tends to be, they tend to be more stable than an all-equity fund, but they have 70% investment in equity. So what we have seen in equity market will have a reasonable, impact on balanced fund as well.
All right. So the advice is on your screen right now. Remember, you can reach us again if you have any questions about investing for your children or for your own future. We have a question that's coming from Kumar Shashank. He has 50 to 70,000 rupees he'd like to put away for 1 year. And he shortlisted the JP Corporate Deposit with an interest rate of 12% for 1 year. And he wants to know if that makes sense. Does he have a better option among debt mutual funds? So, Dhirendra, there are certain risks involved with a corporate deposit. There's also a very hard, lock-in where he can't access that money at all for the next 1 year. Will a debt mutual fund give him better options?
Yeah, first and foremost, I would just like to forewarn that, in making an investment, making a fixed deposit with a company, you are taking the credit risk, and this is an unsecured loan. When if the company gets into bankruptcy, you will be the last man standing in the queue of borrowers. If something is left after the secured debts, then only you stand a chance. And following you will be the equity holders, and they are unlikely to get a chance if the company gets into bankruptcy or faces that. So in that sense, just be aware that this is the riskiest fixed income investment you will be making. So this should be ruled out, or this should be very low on your priority. If you have a large fixed income investment, this could be a very small part of it. If this is going to be the only fixed income investment, don't even think of it. Coming to debt fund, you have reasonable option, but I would say that even debt funds, if you do not choose the debt fund matching your investment time frame, that is the most crucial thing which you have to understand. Money for few years, consider a dynamic bond fund. Money for less than 1 year or about 1 year, think of a short-term bond fund. Nothing less than that.
So I'm going to run that list one more time of how you should divide or how you should choose a debt fund based on the time that you have to invest your money. So you can write that down and you can use that when you're making those decisions. We have one more question. Siddharth has written in, Virendra. He's 29 years old. He has a monthly income of 50,000 rupees. Now he has 2 children and he wants to know where he should start investing for his 2 children to build a strong portfolio. See, he's obviously a first-timer. He's 29 years old. He's investing for his children. Where should he start?
He should try and, make that tax-saving investment first to avail that tax break. Tax saved will be money earned. That will be the first benefit. Then the tax-saving fund. So if he has the tax window available, he should consider a tax-saving fund. If that is completely exhausted with his provident fund and other, any other investment which is entitled for 80C benefit, then he should, first-time investor, he will be very fearful. Getting into a market-related investment, he should consider 1 or 2 of our balanced fund to begin with.
Alright, so I'm going to put on your screen right now the balanced funds that we normally recommend on this show. But Virendra, as far as the tax-saving fund is concerned, if he's looking for a tax-saving fund, can you give him a couple of funds right now that he can use, given his long-term horizon?
I would say that, he should take chances with the tax-saving fund and he should think long-term. He should think beyond more than 3 years, the mandatory lock-in period. If I have to choose few, I would say the Reliance Tax Saver or ICICI Prudential Tax Saving Fund or Quantum Long-Term, Quantum Tax Saving Fund. They should be reasonable choice.
Alright, so Siddharth, there you have it. First, start with your tax-saving funds. Make sure that you're taking full advantage of your Section 80C deduction. If you're already done with that, then of course you can use one of the balanced funds that's on your screen right now. So before we go into break, we know that the biggest fear we have about our money is that inflation is going to eat into our savings. Now, the government would like to have us believe that the new inflation-indexed bonds will help us beat inflation. But will they really? Let's take a look at how these bonds will work, whether or not you should buy them, and where you can buy them from.
बहुत महंगे हो गए कैसे लेवन कैसे काम कर रहे हैं आज क्या बनावे
People like us cannot afford. I don't know what is going to happen to the people who are really poor.
हम बोलते हैं हेल्दी रहने के लिए वेजिटेबल्स खाओ तो वेजिटेबल्स भी नहीं खरीद सकते हैं आप
While inflation shrinks your household budget, it is also quietly eating away at your long-term investments, devaluing your money every passing year. And while you might beat it today with a small grocery list, how will you beat inflation in the long term? Our government suggests we use inflation-index bonds.
In consultation with the RBI, I propose to introduce instruments that will protect savings from inflation, especially the savings of the poor and middle classes. These could be inflation-indexed bonds or inflation-indexed national security certificates.
So, how do these inflation-linked bonds protect your principal and interest? RBI is offering a 1.98% real rate of return on inflation-linked bonds. The nominal return on these bonds are linked to the wholesale price index of last 4 months, which was recorded at 6.50%. This effectively means nominal returns of 8.48%. Suppose you invest 100 rupees in bonds. You will get 8 rupees and 48 paise as returns in the first year. In the second year, the principal will be adjusted to the WPI only for the purpose of calculating your return. So in the second year, the bond assumes your principal is 106 rupees and 50 paise, and 8.48% of that amount is now 9 rupees. So, by the second year, your total returns on your investment will be 17 rupees and 48 paise. While this might seem like a wonderful investment option, it has its fair share of drawbacks. First, the tax treatment.
The return on this product is right now an interest income because it is the interest on the coupon that you get on the thing, and it is taxed as an interest income. So there's no benefit, but there's no disadvantage either.
Also, WPI or the wholesale price index only uses the increase in prices at the wholesale level, which means it does not consider inflation in education, health and consumer products, which is why this bond would have been more beneficial if it based its calculation on the CPI or consumer price index.
They don't beat inflation because it's linked to WPI. But they are better than bonds which are not linked to inflation at all. So the comparison should not be that the new product or new variant that has come in is really going to beat the inflation which a common man suffers. But if you look at positively, up till now we had bonds which were not linked to any kind of inflation index. To that extent, this is better.
Currently, IDBI Bank is the only distributor selling these bonds to retail investors. You can buy these bonds online on the IDBI Bank website. Look for the Samriddhi portal and click on the Inflation Index Bond section. You do not need to have an account with IDBI Bank to buy these bonds. IDBI Bank will also buy back these bonds from you at market price, offering customers liquidity.
IDBI Bank started selling these inflation-linked bonds from the 12th of July. But so far, they've only received 100 registrations and transactions amounting to just 20 lakh rupees. Now, this may be a result of the lack of information about the bonds or the fact that there is only one distributor. But experts tell us to wait and watch for the initial problems to be sorted out. Virendra Kumar is with us as well. It's time for our product review, and this week we're looking at the DSP Black Rock Equity Fund. Avan is here as always to give us an introduction. Avan.
Thanks for that, Faye. Well, the DSP Black Rock Equity Fund has the ability to achieve consistent risk-adjusted returns across market cycles. The fund's well-diversified portfolio complements its performance. Its approach of evaluating economic trends and analyzing various sectors before it invests in stocks has helped the fund during phases or when the markets were volatile. The fund manager maintains an average equity allocation of 94% and increases its cash exposure during market downturns. It has been an outperformer for most of its history, staying within the top 10 funds in its category. Although its performance has slipped over the last 3 years, it barely managed to keep its head above water, and it currently slipped to number 21 out of 30 funds. Let's show you some numbers to give you a better perspective. If you invested 1,000 rupees in this fund, you would have 4,230 rupees today. Despite underperforming the category average only on 3 occasions since its launch, should this fund make a compelling pick? Our experts are here to give you the answer. With that, it's back to you, Faye.
Alright, Avan, thank you for that introduction. Virendra, the DSP Black Rock Equity Fund has slipped a little bit over the last couple of years. Do you think that it can still make a comeback? Should we still have faith in its performance?
Yeah, it has slipped substantially. It has mediocrity written all over its performance in last 2-3 years. And, it is a multi-cap fund. And relative to other funds, it has struggled. And I don't think it has anything big going for it, or it has it has really got any blockbuster its way in its portfolio.
Well, Virendra, for those of our viewers who are still invested in the DSP Black Rock Equity Fund, what should they do now? Should they be pulling out their money?
Moving your money from DSP Black Rock Equity, I would say few other superior options. And that could be a complementary to your otherwise, a diverse portfolio. Could be BNP Paribas Dividend Yield, or Templeton India Equity Income Fund, or even the Goldman Sachs Junior Nifty, which will give you this part of the market, this segment of the market, this capitalization breakup, and also which has been an outstanding performer relative to funds in the multi-cap.
Alright, so on your screen right now are those options. Remember, Virendra said this is not a bad fund, but there are funds that are doing better, that can give you better returns than the DSP Black Rock Equity Fund, and those better options are on your screen right now. Virendra, finally, your rating of the DSP Black Rock Fund, where would you place it?
Based on mediocrity, I would give it a 3-star, and which is where it stands even on the risk-adjusted scale.
Alright, 3 stars for the DSP Black Rock Equity Fund on Investors Guide. Let's move on to our hold or sell segment. Upendra has written in, Virendra, 42 years old. He's a government employee. He began investing in a couple of mutual funds. Now his goal is to create wealth over the next 10 years, and he sent us the list of funds he's investing in. He wants you to help him decide whether or not this portfolio is on track. Right on top on that list is HDFC Top 200, something that a lot of investors have been asking us about. Now, he's already investing in this fund, but he has a 10-year horizon. Is this the best option for him?
Yeah, I think it's a reasonable choice, and don't get perturbed by its recent underperformance, and what has the course of the market looks like the fund is not grossly off the mark. Many of its bets, they are just beginning to, deliver. And this fund has been, very impressive over a very long period of time. So hold on to this. Stay on course.
He also has the ICICI Prudential Discovery Fund. Dhirendra, this is a fund that you recommend on a regular basis for his 10-year horizon and complementing the funds he already has. Do you think this is a good option?
Yeah, I think this is an outstanding fund, and it's a value fund. It has done very well, and this fund sticks to its conviction. And investors should, to benefit from such a fund, you should keep investing even through very difficult times when the fund looks like you are just about to give up on the fund. This fund makes a turnaround, and that is the reward of being patient with such an investment.
So the next on his list is UTI Opportunities, Dhirendra. Continue investing in this one as well?
Yes, this fund has made a remarkable recovery in past 5-6 years. Made a name for itself, and it has carried on the good work despite a manager change. So I would say continue investing. So far, these three funds you have chosen, excellent funds.
Last on his list is the Reliance Tax Saver. Now, we don't know whether this tax saver is out of its lock-in, but assuming it does end its lock-in soon, what should he do with this investment? Would you recommend he continues it?
No, I would say that, Reliance Tax Saver has proved to be a good fund. In its early years, it was not so impressive. And even 2-3 years back, it had a very lean patch. But when I look at these four funds combined together, it's a very desirable, portfolio to have. He should not disturb this portfolio. In fact, if he has to invest some more, he should invest in these funds proportionately. And these four funds, if he's actually making an equal allocation, if he's dividing his money into these four funds equally, they're just as fine. I don't think he needs to add more, and his selection is just perfect.
In fact, Dhirendra, that was going to be his next question. He has an additional 5,000 rupees that he wants to add to his investments at this point. Just spread it across the funds he already has?
Yes, absolutely. He should not add any more fund to this portfolio. He has made good selection, and he should keep an eye on this portfolio and look for the validity of the reasons why he has invested in them for the first time, in the first place.
Upendra, there's 2 thumbs up there from Dhirendra Kumar for your entire portfolio. He's also telling you that you don't need to add anything else to your portfolio. It's perfect just the way it is. So congratulations on picking some very good funds and good luck for the future. Unfortunately, we've run out of time with Dhirendra this week. Dhirendra, thank you so much for answering our questions on Investors Guide. If you would like Dhirendra to look at your portfolio, send in your question to the email ID that's at the bottom of your screen. You'll also find a copy of the show on our Facebook page if you'd like to listen to it one more time. Vishal Kapoor joins us now to answer the questions you sent in during the week. Vishal, thank you so much for spending time with us. Our first question comes in from Kaushal. He writes in, he tells us that he has enough health insurance and enough life insurance, and he can currently set aside about 10,000 rupees every month, Vishal. And he started an SIP in HDFC Prudence and the Kotak Top 50 Fund for 24 months. He wants to know if he should continue this investment. Now, along with this, he tells us he lives in South Mumbai and he hopes to someday buy a home in South Mumbai as well. He wants to know how much money he should be putting away right now so he'll be able to buy a home in South Mumbai. That's quite a tall ask, Vishal. First things first, let's take a look at his 2 mutual funds and should he continue with those investments?
Frankly, it does depend on your risk appetite. We note that you're young, you can take a bit of risk, and therefore Kotak 50, which is a very different product from HDFC Prudence, and it invests really in large cap equities, could be something you continue. HDFC Prudence on the other side is a balanced fund. Now, if you want a bit more moderate allocation, you want a bit more of a conservative, let's say, allocation today, then you would want to continue with HDFC Prudence. Performance may have been mediocre in the medium term or the short term right now, but it is a long-standing great performer, so it's something that you may want to continue with. You could continue with both funds, depending on your risk appetite. The second challenge that you've posed is that you are investing 10,000 rupees in an SIP and you'd like to buy a house for yourself in South Mumbai. Now, that frankly is a question of your budget, but whatever our limited market information goes, South Mumbai is very expensive, so you will have to look at other sources of income or assets that you may have. Even if you were to finance it through a loan, it will be a significant cash outlay you'll have to put in before you can look at buying a house. So that's something just keep in mind that it is going to be expensive, and a 10,000 rupee SIP, while it can generate you reasonable returns over a long period of time, it's the right thing to do, but it will be a long time before the current capital values in Mumbai South will allow you to buy a house.
Our next question comes in from Dr. Vivek Kokni. He tells us that he has an annual income of 10 to 12 lakh rupees, and he wants to know, first of all, how much life insurance he needs. He also wants to buy a family health cover to cover his parents as well, and he wants to know which health cover would suit them, considering his mother is a diabetic, and of course the both of them are senior citizens. Now, apart from this, Vishal, there's a lot of work cut out for you. He also wants to invest his money so he can have about 1 crore rupees in 20 years for his child's education and 2 crore rupees for his own retirement. Where would you like him to start?
In our view, a cover starting with 1 crore to 1.5 crores should be optimal at this stage. You can always top it up as your income goes up later on in life. But for now, start with maybe a crore. Among the 3 product choices or provider choices you've got, I think at this stage, I would just go with the cheaper of the 3 plans, because these are all 3 very well reputed companies. So, go online, check out the quotes. There might be some marginal differences, but, go with the one brand that you really trust, and that should be good enough. It won't be a very big difference, and it's all going to be worth it. The second area that you've asked us for help on, which is the health cover that you need for your family, you could go with 2 choices. One is, of course, buy an individual cover for each of your family members. We would suggest that at least a 5 lakh cover today, and you will be very well aware of health expenses and how they increase over time. So at least a 5 lakh cover per person may be good to start with. However, if that does look like a sizable premium to you, then you could also consider a family floater for an amount like maybe 10 to 15 lakhs. Now, advantage of the family floater may be that should any one person or 2 people get hospitalized, then the larger cover value would apply as it floats across anyone in the family who may need the insurance at a given point in time. So you could look at these 2 options. The family floater may be actually a reasonable option for you. For your retirement objective, where you need 2 crores at the end of 30 years, actually you may need to just save about 9 to 10,000 rupees and put it into a portfolio that can generate about a 10% return. So we're not being very aggressive. We're being realistic in the way long-term capital appreciation could happen. But presume that a portfolio generates 10% return. Actually, an SIP worth 9 to 10,000 rupees should be good enough to get you to your 2 crore objective at the end of 30 years. The SIP should be in a diversified portfolio. For 10% returns, actually a reasonable equity component with some amount of debt component which changes over time as you get nearer to your goal may be a good way to go. The second objective regarding your child's education and marriage, again, it is much closer than you think. So you need 1 crore in 20 years to finance that. And as per a similar at least calculation, an SIP of about 13 to 14,000 rupees per month should get you that objective met in about 20 years' time. If you're looking at 1 crore today, then you have to inflate that number as well for 20 years. So if that's what you want, then you will have to look at a much higher number.
Our next question comes in from a woman investor. Surati has written in. Now, she set aside and saved 1 lakh rupees, and she wants to use it to buy jewelry that she is going to need before Diwali. She wants to know, Vishal, if now is the right time to go out and buy gold, which obviously means she's asking if you think gold is going to become cheaper between now and Diwali. Vishal.
Suruchi, I think, you do want to buy physical gold as an assumption for jewelry for personal purposes. Otherwise, we would have suggested that you look at gold ETFs as a case. But if you do want to buy physical gold before Diwali, look at any day when you see a dip in prices. And the dip in prices are likely when either the rupee appreciates very sharply on a given day, or there is some announcement like, an import duty, change or things like that. So on those days, just watch out for gold prices carefully, and you have a clear objective. So go on those days and buy it. You could actually choose to average it out. You don't have to buy a full 1 lakh rupee on one day.
You can actually choose to buy it over a couple of months because there is a few months to go before Diwali, which is the time when you need this code.
Alright, we've run out of time on the show. Vishal, thank you so much for spending time with us this week and answering our questions. Remember, if you have questions for Vishal or any of our other experts, send them to us. Email ID is at the bottom of your screen. We're also completely partial to our women investors. So for a woman, write into the show. We will definitely take your question on this show. You can find a copy of this show on our Facebook page, and you can reach me personally on Twitter. Thanks for watching.